I was hoping, please don't die on the. Awesome, we're live.
Excellent.
Awesome. Hey, Chris.
Tusuf, how you doing this evening?
I'm doing wonderful. 1 second. All right. So, and I really appreciate Chris jumping on another episode of the Tax Layer series, where we help people answer their basic tax questions and also talk about topics that might be helping them plan for the upcoming tax season for a better tax returns. Thank you again, Chris, for joining us today. Today, we have a very interesting topic, and we are getting into the meat and potato of the series now, is how to touch the money for yourself, your family, and even your kids. If you guys don't follow Chris yet, I recommend following him on both LinkedIn and Facebook. He posts great content. If you're not reading those out, just go read them. Those are great content. And just give him a thumbs up. And I really appreciate that. And with that, Chris, I'll let you start on the topic of taking money from your different corporations. I understand that it might be different for different corporate structures, LLCs, S Corp, C Corp. Let's start from the very bottom. Let's start from LLCs. How does that work out if you're trying to touch money from your LLC?
Well, basically, with an LLC or even a sole prop, is that you can just take money and pull it out and just move it from your business account into your personal account. Now, I would document it saying this is just a withdrawal, because at some point as you move up, the IRS may want to take a look back at some of those withdrawals and say, what were these for? It's, oh yeah, I was an LLC back then. I'm just moving it. But what happens is you've already been taxed on that money, so the IRS doesn't care. It just basically assumes once you've put it on your tax return, that income is just going in your pocket for pizza and beer or your choice of food and beverage. So that's really all that you need to do there. But be sure to document it, because it does go in your accounting system, and you need to correctly record that within that accounting system to say this is exactly what it is.
That's awesome. So I remember we talked about the accountable plan, and Chris told about some of the basic elements of what there should be in an accountable plan. And we also talked about another aspect, that in S Corp and LLCs, once you are taxed, you're not going to be taxed again.
Yep.
Unlike C Corp, which a lot of people might be doing in the upcoming years as the TCJS expires, and there might, as soon as that QBI goes away, we'll talk about QBI in later videos. As soon as the QBI goes away, it might be, depending on how much you're making, might be in some cases beneficial to become a C Corp. And if you don't have those documents, you're probably going to be getting stuck with double taxation instead of triple taxation in the same money that you're making.
Yep, top 5 rules. Document, 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 document.
Absolutely. And if your business has not set up an accountable plan, just do it. If you cannot, reach out to us. Let's help you out. And both me and Chris can help you out set up an accountable plan. We can work together and see what might be the best for your corporate structure as well. But that's a great point that you said, that if I can just take the money from my business account to my personal account. So what you're saying is pretty much the business is taxed just like me. Is that correct?
Yep. That's pretty much it. It's because what happens is, and I get a lot of questions about this, is so, well, what happens if I move? I went and I moved money from my business account to my personal account. Am I going to get in trouble? Well, no. Does your spouse know about it? Oh, yeah. Not going to get in trouble. But really, it's because you're there. Yeah, the IRS has already taxed it. It just moved over, and you're good to go. Or it's going to be taxed. The IRS taxes income, not wealth, for the most part.
That's an awesome statement.
when you're making the money, that's when they're going to come and get it. So when after you have it, and there's going to be other things in future videos, we talk about not being taxed on your wealth. But let's stick with the main topic here. That yeah, just move it from your business to your personal. All done.
I want my viewers to take and consume this statement. This is gonna be a golden statement you should be writing in your office. IRS taxes your money, not your wealth.
Taxes your income, not your wealth.
IRS taxes your income, not your wealth.
Yep.
Help us understand the basic differentiate between wealth and income.
Okay, so wealth is you're starting out, and your wealth basically is what's really on your balance sheet. It's going to be the cash that you have sitting in the bank. It's already been in there, so you can't be touching it. It's your real estate. It's the assets that you own. They're not going to tax. The federal government's not going to tax that. Now they may tax like your real estate and your property taxes, and you can talk to City Hall about that because I think it's done at a local level. And we just had elections here in Virginia, and it probably affected how some of the races went. But for the most part, the federal government is not going to tax that. They're going to just leave that alone. Income is the money that you make. You go out and you earn the money, whether it be through your W-2 job or the businesses that you have, and money's come in, and then the IRS says, I want my pound of flesh, so I'm going to take some of that income that you earned and I'm going to pull it in for my purposes. But they're not going to look at your bank account. I don't know if you remember, Tusif, there was a big thing a while back about the 1099s, how they're going to change it to the threshold. Before it was $600, and they were talking about getting it down to like $1. And I got so many calls. And I went at a conference like the week that happened, and I got so many panicked hair salon owners just panicked about this. And no. There's a trial balloon. They're just floating it. It's not going to happen because, or if you're afraid of it, call your representative, call your senator, and say, you don't do this, because they actually know we're delving into politics here, but I had a friend who served in Virginia House of Delegates. He said, look, any letters in favor of or against, they get read. So if business owners, if you don't like something your government's doing, please reach out to your representative and tell them, hey, I don't like this. And because that will help them either vote something down or vote something up. So
absolutely.
Make sure that you're a business owner. You did build that. So make sure that your representatives know where you stand on it and what will help your business.
That's awesome. So people, especially the business owners, if you feel like you are not liking any kind of laws, start getting into the habit of writing to your representatives. That's a great way to contribute to the society, exercise your rights as an Americans, and it's a great privilege that you guys are having that, to be honest. So make sure to use it, and it's a great opportunity for us, even now, whatever's coming up. If you don't like something, reach out to your representative and see if we could get the things better for the future.
Yes, indeed.
And what you just said, Chris, is if we can transfer our income to our wealth, we're not going to be taxed, essentially.
Well, essentially, and that's going to be a little bit harder, and we'll delve more into that in future broadcasts as to how that can be done. But for the most part, as you're earning it, you're going to be taxed. But once they're done taxing it, it goes into your wealth column.
Awesome.
So and then you can use that to actually create more wealth and maybe some more income that hopefully is taxed at a lower rate. So dividend income is going to be taxed at a lower rate. So just some things to keep in mind as we move forward to the series.
That's awesome. Yep. We will go much deeper into all those strategies in the future episodes, but let's come back to the element of moving money from your business account to your personal account. So if I'm a sole prop, can I hire my wife and kids? And if I do, how should I do that?
Okay, well, if it's your wife, now my wife works for me and she's great, but it also makes sure that you do have the lines drawn. My wife she is an employee. and get them set up as an employee. Treat them like well, let me say, document your things like they're an employee. Do not treat your guys, do not treat your wife like your employee, okay? Please don't. All right. And Joseph, this might be a little thing we break out here to a short, that me saying don't do that. But what you want to do is document everything that you have on there. It's a timesheet, log the time, have a job description, work with a payroll company that can make sure that all the reports are being filed and that they are recognized as employee. And what that does is, as a business owner, a sole proprietor owner, you're being charged with self-employment taxes. Well, what you can do as paying an employee is take that and make that W-2 income, which is not subject to self-employment, and move it over to another section of your tax return, so that you'll still have to pay Social Security, Medicare, and all that stuff on it, but you'll pay the employer's share of that, but you will be able to deduct the employer's share of Social Security and Medicare as a company deduction. Another great thing is that it helps with estimated taxes, because if you're withholding money from their salary, that's going to go on your 1040 as the withholdings, and it's going to help lower the final tax bill that you have. So I like doing that and using that as a vehicle to lower the tax bill at the end of the year, because it's a lot easier to pay a couple $100 a month than it is a couple thousand at the end of the year.
Yep. That's a great point you brought up, is unless you are having an exclusively separate account for Uncle Sam and also paying them its ETFPS on a yearly basis, you do realize that you're going to end up with not only the taxes you owe, because by code you should have been paying those each quarter. So that at the end of the year, if you owe some taxes, not only are you going to be paying on those, but also you're going to be actually paying interest on those for each quarter.
Yep.
So it's always much beneficial if you're running a payroll and just have those taxes withheld instead of getting through a big chunk of tax bill at the end of the year. That's a great point you brought up.
Yep.
So in that same regards, as you just mentioned, can a business owner also hire a kid like 5-6 year olds and have their stuff as a payroll as well?
Well, so usually what the tax courts look at is usually 7 is the dividing line, and it's really what you do is that, yeah, you can set them up. Here in Virginia, there is a rule, and if there's a lawyer watching this, please double check and then write in the show and say, okay, you misread that. But if you own your own business, your kids are not subject to the child labor laws. So
that's awesome.
You can hire them as young as 7, and really before 7, they're not going to be able to do much. I mean, you are not able to deduct as pay, $5 to leave you alone while you do some work. That's not something that you can deduct. But I have a friend who's out in California who runs his own business, and he posted on Facebook his son putting together binders for a client. And hey, it's work he can do. They logged his hours, and he paid him a good rate for it. So yeah, that was perfectly legal. It really is what they can do. And I was taking a tour of a local high school the other day, or actually a couple months back, and they have like TV studios. These kids are just state of the art now. So some of your kids and teenagers probably can do a lot more than you think they can do, and work with you on social media and what have you. So older guys like me, like I'd turn to my kids and say, okay, well, how do you do this? So there's things you can do, but if it's appropriate for their age and you're paying them what you would pay somebody else to do, then you certainly can bring them on as employees.
Awesome. Let me ask you a more of a borderline question here then. Is you said that the threshold is typically age 7.
Yep.
But we all understand that cuteness is something that is for sale. And if someone is using their kids as social media posts, as you just mentioned, leveraging their cuteness, or their whatever the small kids do, can they have a payroll that, hey, they're gonna be being cute in front of the camera for my Facebook and YouTube audience. I'm gonna pay this much. Is that a very reasonable thing to say?
It is reasonable, but really, I would also talk to a small business attorney and just to make sure that you're not violating anything with that. And seven, like I said, that's kind of the violation. They've gotten through first grade and they're starting to understand some stuff now. But yeah, check with a good attorney to make sure that you're not violating anything by using them in a business, and what their rights are and what you can pay them for having a cute kid, 3-year-old in their business. And most of the time, people aren't going to do that. But if you're thinking about it, sit down and talk with a lawyer to make sure that you're covered there. It's you want to stay on the up and up in that, and really, how much you're going to pay a kid to sit there and eat Oreos online or something.
That's a good one. So let me follow up with that. So beyond 7, we're pretty good. And if that is the case, most of the cases, these kids are going to be dependent on the business owner themselves because they're their parents.
Yep.
And the standard deduction for dependent is almost 1/3 of an adult. So if someone, say for example, a business were to pay $4,400 to a child a year, does that mean when they include him or her into their tax returns at the end of the year, they can actually not pay any tax on that $4,400 because that becomes a standard deduction?
So what the dividing line is a standard deduction. Yes, you can claim them as, if you're providing more than 50% of your 50% of their support, then yeah, you can claim them as your child, as your dependent. It's only when you get to the upper teens and the college years that's going to come into play. But what happens is, and the great reason for paying your kids is that you can pay them up to the standard deduction, and they don't have to file a tax return on that, and you get to deduct the what you paid them and any Social Security tax, Medicare, what have you, that you match and take that as a deduction. But the kid doesn't have to do anything as far as filing a tax return if they're below the standard deduction. If you withhold federal taxes, yeah, then have them file it so they get the refund like we all hope for.
Awesome. So that's a great point you brought up. For all the business owners with kids, make sure to see if you can actually have them on a payroll, even if it's a small thing. And even if you put them maybe in a Roth IRA, which is supposedly out post-tax dollars, but the fact that they're not having to pay the taxes,
yep,
essentially by the time that they reach a college age, they have a Roth IRA which accumulated interest, and all of them is going to be tax-free.
Yes.
And if
that's the way, really, you don't have to pay them with a check. You can make a contribution to an IRA, another retirement account, even a 529 plan. We have these here in Virginia. The only thing is that if you're claiming the child as your dependent, you can't take the deduction for the 529 contribution if you've made it in their name by paying them by a contribution to a 529 plan. So just something to look out for.
Awesome. So, but if the child were to take it as a salary, then they can actually contribute for themselves to 529?
Yes, they can.
Awesome. So that's a great opportunity for them, and starting to educate your children on basic finances in US. Yep. And essentially what you're giving them is a much better financial situation by the time that they reach college. If done properly and with proper vehicles, that might even be in a situation that it pays for their college education as well, if
yes,
done
indeed.
long enough. That's awesome. That's a great option that you brought up. And let me ask you this then. if they were to start owning properties, or as you just mentioned, wealth, how would that work out in terms of income? Because as you just mentioned, IRS taxes us on income, not wealth. So if it happens so that we are transferring wealth to them as opposed to income and have that income to be below the standard deduction, how would they be taxed?
Okay, so it really depends on how much income they have. And I believe that the level that we're going to look at here is $1,250 share for 2023 for all those watching this 10 years down the road. So what's going to happen is that if it's below that 1250 line, there's zero income on it. If it's the next 1250, it's going to be whatever the kid's tax rate is based on their earnings. But if it's above that, then that 1250, like now it's going to be 2500. That income will be taxed at their parents' rate, and it gets a little bit more complicated because there's stuff you need to include on the parents' return, what have you. So all that's taken into account. So while it's a good idea to shift the income there, you're kind of limited as to how much you can, because the IRS will say, okay, it's up to this point, but nope, you're going to have to take the rest of this, and you're losing the break on it.
So essentially, if someone crosses that limit, if I remember correct, it was 4,400 if for earned income.
I think so.
Okay.
I think so.
And 1,250 for unearned income. So if they have rental income more than that, then definitely make sure to not go crossing that. So what happens if he has both of those kind of income?
Well, that does get what you mean, unearned and earned income, or
yes. So say for example, I have a child who I'm paying $4,000 a year,
mm-hmm.
and I have a rental property that makes $1,000 a year that I make him the owner of it.
Right.
So,
I would actually file a return for that just to document that this is what's happening. They have rental income. Sometimes a tax return is filed to make sure to show the taxing authorities or what have you, this is what's going on, and to show ownership of certain things so that it's down the line you can actually go into court and prove it if there's some kind of dispute. So awesome. I would file a return on that.
Okay. So if there is a combination, definitely reach out to either us or Chris, and let's have it filed, just because it's probably not going to cost you a lot here, but if you do have to go to the court, you probably is going to be looking at significant multipliers of that same expense. So it's more like an insurance thing that you're paying.
Yes.
Awesome. You brought up a very interesting term as kiddietax, I believe that I heard. Run us around that. Is when does that happen, and how is it that the parents have to include children's income into their income tax? Isn't it actually doing the same thing unless we're taking it to our return or their return? Is that where's that threshold that becomes it profitable for the business owners?
When does it become profitable? Well, the thing about it is that the kiddie tax is going to be mostly for the unearned income. That's going to be interest, dividends, capital gains, sales, what have you. So that's when the kiddie tax is going to kick in. If you're paying them as an employee, it doesn't. There's no kiddie tax involved with that, because it's what's been earned by them for putting together binders or being cute, eating pretzels, what have you. So I wouldn't necessarily. You want to make it as close to that standard deduction line for a single person. Of course, your kids should be single until they're in their 20s. So we won't go too beyond that. But you want to make sure that up till there, they don't have to file the tax return. But it's more of if it's earned, they're not going to be subject to that kiddie tax. But if it's unearned, that's when the kiddie tax kicks in.
Awesome. So for kiddie tax, you said it becomes more of the unearned income structure that you just mentioned, where
Right. It's right. Well, what's happening or what happened is that they saw that the parents were shifting a lot of the ownerships of stocks and bonds to their kids so that they could take advantage of this 10% or whatever their lower rate is, and then so that they could shift some wealth down there. And then the IRS caught a hold of this and said, no, you don't want to do that, or you cannot do that. So just to make sure that they get their pound of the IRS wants their pound of flesh, and that's the whole thing with the required minimum distributions, which we'll talk about a little bit later. But the IRS is always going to want to make sure that they get their pound of flesh. So they're always looking for ways to make sure that you're paying your taxes. I mean, rich people get rich because they understand the tax laws and how to work around them. But they also know that things could change when people get a hold of this. And like we said earlier, write a new representative about what you want to see happening, because there's going to be somebody who says, well, that's not fair, and then write them in and try and get something that's going to hurt you as a business owner, as a parent. So again, keep active in politics.
that's awesome. Let's move on to the corporations then.
Yep.
An interesting thing that as an earned income, you can actually pay your employees with stocks.
Yep.
And as a matter of fact, if someone owns a C Corp, say, for example, one of my friends owns multiple grocery stores, all of them under a C Corp. And if he starts to pay his kids instead of a salary, the equivalent amount of share stock price, they take that, similar to what we discussed earlier, under a Roth IRA, that hey, since I got paid of those C corporation as stocks, these are now my earned income. I was supposed to pay taxes, now I'm not paying taxes because it's below the threshold of earned income. Can I now take that ownership interest and put them into a Roth IRA?
That would be something to talk to a financial advisor about. And being that I'm a tax guy, I do have certifications with securities. As far as what the securities laws goes, I really would sit and talk to a financial advisor about what can go into the Roth IRA. So that I'm going to punt that one over to some good financial advisor on that one.
Awesome. But on an overall basis, someone can start earning stocks into the business with their earned income. Yep. The only caveat to it is if the business owners distributes dividends further down the road, they would have to be qualifying as unearned income number as well, and might just become subject to kiddietax as well.
That would be the case, and it requires some tax planning. So folks, get together with Tusif and I. We can take a look at your individual situation, say this is probably the best thing for you, and it may be some bitter medicine that you got to take, but our job is to look out for you, make sure that nothing happens, that you're going to get a letter from the IRS saying, nope, that you can't do that.
Absolutely. That's awesome. Now, I jumped back and forth in the corporation. I started in the C Corp, but let's get back to some of the aspect of both S Corp as well. As we spoke about, I know that S Corp can have highest 100 shares that you can issue. In that case, can those shares be also given as earned income?
Yes, if you are providing services in exchange for those shares, and yeah, that would be considered income.
That's
so
awesome.
You're bringing people in. You get 100 shareholders in there, and so if you want to bring in more, and you always talk about how, or one of the things we talk about is you would issue shares because they have a vested interest in your company, so they're going to want to see your company succeed. So they're going to be working a little harder to make sure it is, or tell their relatives you need to go and work, buy stuff from this company. So it's
Yep.
something that we learned in way back in college, whenever that was.
That's awesome. So people who are watching this, depending on what your structure is, make sure to reach out to Chris or me to understand the implication. This might be a very powerful tool you have on your tool belt, if especially you are trying to retire and give these to your children.
Mm-hmm.
And or if you're planning on retiring to give it to your children, but you need to understand that when you're going to be distributing the dividends, they would also be paying taxes on top of what they're gaining now. So
Yes.
make sure to understand those, and also understand the fact that what your goals are, what your exit strategy of
Yes.
a business is. And as Chris's 5 laws is document, 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 document. Make sure to have that. It's always better. I feel like I actually have it myself, is to draft up by an attorney some of the
Yes.
bylaws and stuff, which allows us to sometimes move around with the stocks, even though I'm the sole owner. But for C Corp, you have to have those board meetings. You have to have those quarterly or yearly meetings where you have to make those decisions on the paper. You need to sit down and document.
Yes.
And
Absolutely.
remember, if you are having your children and your family in your corporation, those can be in your vacation time. That
Mm-hmm.
becomes a corporate meeting.
Yes, it does.
So that's one thing I always suggest my clients is not let's look into if and what we can deduct, but how can we also deduct some of your personal expenses, whether supposedly personal, but we can, for proper reasoning, which
Yep.
is normal and which is very customary, we can actually make transfer from one side of the P&L to another side as
Absolutely.
personal expense to business expense.
Well, and you also
Awesome.
got the things like the Augusta rule. I don't know if you want to say that for a future or you want to
Yep.
go open that can of worms right now. But it's a rule. I don't know how many of our audience has heard of the Masters golf tournament. Now, I've been down there, and I can tell you, it is an internationally known golf facility surrounded by a little bitty southern town. So you got 30, 40, 50,000 people converging on there to watch this tournament. And the question becomes, where do they stay? There's not a lot of big hotels around there. What happens is that the residents of Augusta get out of Dodge and they rent out the houses to the people coming in. And guess what? They don't pay any taxes on the money they bring in, because the rule is if you rent your house for less than 14 days, you don't pay money on that income. And now how
That's
this works
awesome.
for business owners is if you have a corporation, you've got a building that you go to that you own, but you want to have a team meeting at your house, you would we can discuss this more later, or a consultation with us, is that you just call in and get a quote from a local hotel, says how much will it cost for us to host a meeting there. They'll send you the quote, you put that into corporate minutes, and then the corporation writes a check to you personally that is going to be tax-free income because you held the meeting there.
You
So
just made me excited, Chris. That's a
yes.
wonderful, wonderful way.
Yep.
Think about it for a second. You have a big enough house. You have all your kids and family members in your house. Thanksgiving dinner becomes augustarule deduction.
Well, you do need to have some business material and provide an
Yes, of
agenda, what
course.
have you, because eating turkey and falling asleep during a football game are not business activities,
Absolutely. So you need to realize
unless you're
that.
Taylor Swift, by the way.
That's a good one. So whenever you're doing these, remember you actually have 14 days of renting your own personal residence to your corporation, whether it's your employees, your in-family business owners, and also your out-family business owners. Have a get-together, of course. Another important thing, as Chris mentioned, you're not there to just eat turkey and fall asleep. You need to keep proper meeting minutes. Your corporate record books must, I always say it's a must that you keep those meeting minutes. Even if you guys decide that, hey, okay, we decided that for this year, we're going to be doing business in this way. Have this conversation in your house, 14 days. And you just actually are able to take that quote from a local hotel for renting a conference room for a certain amount of hours. You get that code, attach that with your corporate meeting minutes, and that's your record. So let me ask you this, Chris. When a corporation writes a check to my personal self, do I have to indicate that on my 1040 on my personal return?
No.
That's awesome.
It's tax-free money.
That's awesome.
Yep.
How cool can that be? You're getting money out of your corporation without even declaring.
Yep.
And that's legal.
That's legal.
And I really appreciate the people of Augusta, Georgia. I believe that was their idea, and that was a great thing that they blessed us. If someone is from Augusta, Georgia, hey, another applause from us.
Yeah, well, Tusif and I will come down and have some waffles at the local Waffle House, which is going to be an experience, Tusif. So if you haven't had it yet, we got to get you down there for some waffles and some hash browns.
That's awesome. I used to live pretty close to that few years back, and Georgia's a great state.
Yes, it is.
I feel like the weather suits there more than I'm here. We're getting cold, but hey, you probably need to have enjoying the cold to applaud the hot summer as well.
Yes, indeed.
All right. So we talked a lot about very interesting points today about paying to your children as well. Now let's talk about the aspect of other vehicles like self-employed retirement plans.
Yep.
Touching your money out. Walk us through a little bit about that. How can it benefit if there's husband and wife working, just like your case? Husband and wife currently working in the business together. They're a home team and a business team. That's a great combination. How can they take benefit of that contribution?
Well, I always like these people say, well, I've got a Roth or I've got an IRA. Well, you have an upper limit as to what you can deduct. And if your total income is above a certain amount, you can't deduct any of it. Or if you have a Roth and you've made contributions and your income is above a certain amount, you can't even make the contributions, let alone deduct them. So it's like, well, what do I do? I've had clients who say, well, shoot, why did Congress put this in place if I can't make a contribution to it? And the thought was, well, you contribute to it when you're younger. Well, I had no money when I was younger. Well, this is why you write to your Congress people or senators or what have you. But so here's the thing with the self-employed retirement plan, it is in the different plans. You have your SEP, you have your Simple, you have your Solo 401k, KEO plans, what have you. And we probably could go into that in more detail in a future show. But the great part about it is it's up to, in some cases, 25% of your income after expenses.
Wow.
And you can deduct that. Now, the great thing about it is that you don't have to make the contribution until you file your return. Well, how does that work? So Tusif and I will do your return. We'll get everything together, and then we'll call you up and say, yeah, by the way, here's what you're going to owe. But I know you've got a self-employed retirement plan. If you make this contribution, it'll lower your bill by this amount. And
That's
then
awesome.
You can make that contribution by the time you file April 15th or the extension. You can lower your tax bill, and the contribution will count for the prior year. And that's what I tell my self-employed clients is that, hey, don't go to sleep on this because this is a way to solve it. You'll get questions, and just if we probably ask this, well, what if I go and I buy a Tesla? Can I use that as a big tax deduction? Well, you own a dog walking business. How's that going to help your business? So you need to make sure that you when you deduct things, it's going to actually be so the IRS will go, yeah, that's something that they can do in a business. But so everybody have a self-employed retirement plan because Lord knows you don't want to do this forever. So take advantage of those.
That's a very powerful statement. As Chris mentioned, IRS always puts out these two words, ordinary and necessary. As long as an expense is ordinary and necessary, justified for your current operation or your expansion, that can be written as an expense.
Yep.
But as Chris is mentioning, you don't need a Tesla for a good dog walking business, people. Okay? I mean, you could probably say that, hey, I need a Tesla for moving from point A to point B. Like if you're a real estate agent, you have a lot of showings. You might as well claim the EV credit, which we'll go much later into some other videos. And also say that, hey, having a car is an ordinary and customary situation, and I need to drive a lot, so I'm buying a car. It can be Tesla, it can be Range Rover. You can also market that, hey, I'm making this an ordinary and necessary because I'm actually showing these to upper echelon of people who a high net worth individual. I'm showing multi-million-dollar houses. So it's not probably going to be the best impression if I'm taking my Prius.
There you go.
No offense with Prius. I love Prius. I'm all in for this. But when I'm probably going to meet as a business partner of Warren Buffett or Chris, like some big people, Amazon's guys, you probably want to say that, hey, at least even if it's not a Tesla, a BMW or something, it makes an impression.
It does.
So if it is like that, yes, that is an ordinary and necessary expense. But as Chris always gives out the example of, don't spend and come to us saying that, hey, I have a nail salon and I want to have an ordinary expense of a 16-wheeler truck.
Mm-hmm.
So that's going to be significantly different. Awesome. So let me ask you this. In those retirement plans, as you just mentioned, it's great to have someone know how much they want to pay taxes or need to pay taxes. As a matter of fact, I always say there's few situations you should be paying taxes. We're going to go into that some later case, but if someone were to move his money from his business account to these self-employment contributions, what is the procedure to touch the money again, since we're talking about touching money? And is there a possibility to take loan against them?
Yes, and that's something that you talk to your financial advisor about and see. I always caution about doing that because you want to work with a good financial advisor and develop a plan. And then if you run into something, not just automatically go to your retirement plan. We have a great columnist with Washington Post, Michelle Singletary, that I used to love to read. And so she would point out, look, your kids can get loans for college and they can work those off, but there's no loans for retirement.
Yeah.
So you don't want to mess with that, and check with your financial advisor about, okay, how would this loan affect my situation down the road? What's going to be the catch if I take a loan against it now? Like if you have a 401k at your job,
Yep.
and you take a loan, and if you get laid off, hey, that loan's coming due when you get laid off.
Yep.
So sit down, slow down, talk to your financial advisor. Shusif and I can certainly walk through the basics of that to make sure that you're making the right decision. There may be other ways to fund what you're looking to do, but yeah, there are loans that you can take against it and have some money there tax-free. But ask yourself, and ask your advisor, is this the right thing for me to be doing?
Absolutely. And in most cases, if you are in your 45, 50s, just wait a few more years and you can take it out tax-free in many cases.
Absolutely.
Or at a lower tax bracket. Right.
59 and a half is when you can start taking distributions. I'm about 7 years out, so I'm kind of waiting.
That's awesome. The better, I mean, better and I'd say not so better is when you are planning your taxes or even retirements. If you're planned properly, you can not only reduce all of those burdens of what you need in terms of money. That's why Chris and I have a wonderful CFO services. So CFO purpose is not just to save you on taxes now, but what you're going to be doing with the money in the future as well.
Yep.
So understand your situation and the fact that when you're going to be taking those money, if you have to take money, then yes, you have to take money. But remember, the moment you are having those into those retirement plans, if you need liquidity on a long term, on a permanent basis, you need to consider that there is going to be, in most cases, a 10% penalty of early withdrawals from those plans. But the best thing is, if you're like, you know what, I want to keep my money to myself and we're filing those taxes, and all of a sudden you see that, hey, I could actually not pay that much taxes and just move my money from this account to that account. Yeah, I don't need that money now, but eventually I'm going to get those money at a significantly tax benefited way. And in many cases, the interest out there might even be tax preferred.
Mm-hmm.
So make sure to sit down with your financial planner. And also, let's have a conversation of how much money, where to move it, when to move it, and let's have those set up in the best possible way. Now, moving on to the corporation again, is when you are paying yourself a salary. I know you just briefly mentioned to set up a payroll company, separate payroll company. Can someone run their own payroll? And if so, what are the fundamental elements that needs to go so that we tax preparers can see that, hey, okay, you did it right?
Well, so I really advise unless you're wanting to run a payroll company, that you don't run your own payroll, because as a business owner, you've got a lot of balls in the air, and you have not only federal reporting requirements, you have state reporting requirements, and potentially local reporting requirements. I believe up in Pennsylvania that there is some local taxes that get reported.
Yeah.
So I really would say don't run your own payroll, but also maybe just be aware of the forms that need to be filed so that you can keep on top of your payroll company. You know what's going on. Just because I'm saying don't run your own payroll, I'm not saying don't be aware of what's happening. Because you
Awesome.
are the CEO, you want to know kind of what's happening. President Biden has advisors and he's got cabinet members who report to him saying this is what's happening. President Biden doesn't necessarily know all that everything that goes into the sausage, but he knows that he's got the sausage has been made.
Yes, know enough to make an intelligent decision.
Yep.
You don't need to know all the nitty gritties. Like if as a business owner, you need to pay taxes. Know the basics. That's what we have the show. Understand the basics. But if you want to know every single IRS code, it's probably not the best usage of your time unless you're becoming a CPA yourself. So to follow up on your questions of your follow up on your answer of yours, Chris, is what are the fun basics that someone needs to know on a payroll?
Well, the basics would be is what you're withholding, what the rules are with that, what can be withheld, what are the deductions that you have the option to offer your employees. So not only is it, okay, here are the rules as far as what the taxes are, but what benefits can you offer them to keep working in your company or to hire new talent? Back in the 90s, it was, the foosball tables and what have you, but that may be something that doesn't show up in their paycheck. But what can you offer them and what are the rules around it? I mean, retirement plans is a big one. So what are the rules there? When do you have to file additional forms for that? So those are questions to be asking payroll administrative company or whoever's running your payroll. Just be aware of those.
That's awesome. As I would probably add what forms are associated as well.
Yes.
Because when you are running a comp, say for example, a lot of friends of mine doing fix and flips, they are involved into running their own contracting managements as well. So many of them have to probably issue 1099s.
Yes.
And just understand the basic. You don't have to go through all of the 1099s. Just understand the basics. One or two of the most common that is relevant to yours. If you don't know, reach out to us. We can probably answer some of the basics as well. And maybe what you're also going to be getting, like if you're a C Corp and you're taking money out of it, remember that at the end of the year, your company needs to issue you a W-2.
Yes.
So if you are a C Corp, we're gonna, and whoever's filing us, if either we or anyone else, C Corp filing is completely separate than your personal filing. That is being the reason that C Corp gives you a significant more protection on your personal liability, and in some cases flexibilities as well. But in terms, it does not recognize you as part of it. It recognizes you separate. So let me ask you this: if I'm owning a C Corp or an S Corp, can I contribute to that self-employment retirement plans? And since that margin is much higher than personal cases, is there a possibility or ways if I'm a C Corp or an S Corp as opposed to an LLC?
Well, with the S Corp, that you are able to do that, and it would be probably through the S Corporation that you would be doing that. The C Corporations, they're going to have their own type of retirement plans that you can sit and talk down to your financial advisor, say, what's the best one for me? And probably not a SEP or a simple would be available. KEO possibly, but normally it's going to be a 401k plan for corporations. So really, again, that's a sit down with your financial advisor, see what's best and what the contribution. And I have a financial advisor that I work with all the time, and we always throw stuff back and forth about certain clients because we have that relationship that allows us. We've signed the forms to allow us to talk back and forth.
That's
So,
awesome.
yeah.
So if
Find
anyone,
a good team.
Yep, anyone who is building a team, build your team.
Yep.
Find good people and also hire people who have good networks, just like Chris mentioned. I might not be expert on every single aspect of every single thing, same thing as Chris, even after 10 years of our experiences each. But the fact that we have connections with some of the greatest minds in the industry, that allows us to leverage other people's experience and knowledge, which is a great option that you brought up. So in case you are an S Corp or an LLC, sit down with your financial planner, sit down with the tax planner, and understand how much you need to contribute so that the amount you want to pay in taxes is that all that you pay in taxes. But this might just, what today we have been talking about might just be a great option for you to touch more money from your business, because we just today summarizing mentioned about potentially paying your kids. If you have 4 kids, like one of my friends, looking at about a good 13, 14 grand of deductions without having to pay taxes. If they're also into your business, you're looking at another Augusta rule of 14 days of a good touching your money without much of taxes. If you have your wife or spouse or significant others, I guess it needs to be spouse for some of the legal aspects. If they're also supporting you in business, you could probably leverage a few good chunk, because since your spouse is an employee now, she's an adult, her limit is not that 4,500, 4,400. Now she is 12, almost 13,000 this year is going to be. So you are looking at least 36 or more $1,000 for your family to touch tax-free in this just 1 hour video today. That's
Yes,
awesome.
indeed.
Any other thoughts comes to your mind or suggestions, Chris, on today's topic?
Well, it's really always sit down and talk with your CPA financial advisor, and just they'll throw questions at us. You may think, oh no, that's a dumb question, I want to ask. No, ask the question, because the stupid question is getting the IRS notice and saying, well, what do I do?
Yep.
Now, granted, asked us that question, but you probably didn't tell us something before to make sure that notice didn't happen.
Absolutely.
Always document, and make sure that you can go back to, because the cases when I've been in front of the IRS, when we've got all the documentation lined up, because the client made sure they kept good records, it was a very relaxed meeting. The ones where they don't have it is a lot more tense. So
Absolutely.
have everything together there, and so that you can make sure that everything goes smoothly if by some chance, the 1% chance, you're going to get audited. So keep everything together.
And remember, folks, that financial planners and tax planners in your team and lawyers are your financial doctors. If you go to a doctor and don't mention all of the drugs that you're taking, and they prescribe something else, and you end up with some sort of side effects, that's your fault.
Mm-hmm.
You need to be cognizant and be open-minded. And remember, all of these legal professionals, we're not out there exposing your trade secret or financial secrets. That's protected by law. So when you're coming in, understand what your goals are, be open to those. And it can be as crazy as like, hey, I want certain money for bungee jumping. It's okay. Maybe we can have that some sort of corporate meeting on a bungee jumping center. You get part of that deduction as well. It's fine. In life, you are making money to enjoy it. So, but be open to it so that at the end of the year, you don't record it. You don't have any relevance of business to that bungee jumping event. And you go there, you deduct it. That's not something that we can do. So that's something that be open to it. And I'm going to end this one with the most profound statement that Chris made today is IRS taxes on your income, not your wealth. So focus on generating wealth, not just income. With that, I appreciate Chris. Thank you very much for all of our viewers. And if you have any other questions, feel free to drop here in Facebook or even LinkedIn, even in YouTube comments. We would love to answer those in the future videos. With that, thank you very much. Thank you for Chris hopping on, and good night, everyone.
Thank you too, Stephen. Y'all have a good night.
Bye.